I think it's just afternoon. Afternoon, everybody. I have no idea what he just said. He could be introducing entirely the wrong person, or he could have said something incredibly rude about me. I don't know, so I'm happy. So I'm going to talk to you about one of our funds that we run in the real asset space. First of all, I'm going to give you a bit of background as to how we came to run such a fund. My background is 20 years in hedge funds. And the whole point of hedge funds during that period was to try and find a return vehicle that was different to the main markets, different to equity, different to credit, different to FX, different to real estate, something that was truly non-correlated and sometimes uncorrelated, something that if markets crashed, it wouldn't feel the impact in the same kind of way. It would protect a portfolio from a downturn. And that theory held pretty well for quite some time. We tapped into some good skill, people doing some interesting things, using some of the tool bag the banks were giving them to generate returns in a really different way. And that was great until it wasn't. And in 2008, that was the moment when it all stopped and it all changed, where the only thing that went up was correlation itself. Returns across all types of investment were deeply challenged and went down a lot. And really, it was only that correlation matrix that moved. So it forced us to rethink how we might approach investing in something that was truly different and would remain different even if the markets broadly had a similar liquidity crunch. Of course, we've seen crashes before and they take many shapes and sizes. The next time we have a problem in markets, it will, I'm sure, be different again. But we've tried to find an asset that would and should not be impacted by the sentimentality, the market issues that are caused in times of disruptions, which is how we've ended up where we are. We looked at a lot of different ways of investing in different asset types, kissed a lot of frogs to get to the one that we're investing in, that being an applied property portfolio. So what we're doing is, rather than just investing in property for the return of property itself, actually looking at what you do with that property and turning a physical attribute into something that generates very sticky, very consistent returns. So where we ended up is investing in residential healthcare in the UK. Now, as it turns out, I am English, but we are actually a Swiss company. So the UK bit is not an accident of geography. It is a very specific focus on an asset and a particular legal regime that supports that asset. Just the headlines are fairly obvious, I guess. If you're going to be investing in residential healthcare, who are your customers? Who generates the yield? The first one is the elderly, care of the elderly, and that's defined in residential healthcare as people at 85 years old who usually have residential healthcare for the last 3 years of their lives. So you're looking at that subsection of the population, and I think everybody understands that is a rapidly growing area of demographics. The other area that's got substantial exposure in residential healthcare is the care of adults with learning disabilities, which is an area that interests us very much because it has a very, very solid legal support to it and a very, very solid yield generation. So the reason this ticks a lot of our boxes is it does actually satisfy our thesis of an asset that is generating high yields and is structurally not going to suffer from a market downturn if we get an equity market hit or a property market hit or credit markets suffer. And here's the reason. It's a large and growing market. You cannot argue with demographics. Demographics just are. It's not fashion. It's not politics. It's a matter of fact. The aging population is growing at a rate, and adults with learning disabilities exist and will continue to exist. Politicians cannot turn them off on Monday morning. Markets, banks cannot turn this thing off on a Monday morning. It continues, whatever. The other thing we like about it is the barriers to entry into this market are very high. You need a lot of capital to deploy because you have to own the properties and have trained staff to be able to deliver care. So other players just cannot turn up and take your market, your yield from you. It's also very highly regulated, which is, again, another very important barrier. Regulation of this type of activity in the UK is probably the most regulated type of any activity at the moment. It's very visible regulation. The care homes we own, you can go to the website of the regulator and see the score for each one of those homes. So that prevents other people coming in and stealing our yield from us. And then the correlation to other mainstream assets. We've got, it's a physical issue. I mean, gold is physical. You can't change gold, but however you can move gold and devalue gold. The nature of this physical asset is you've got a person who requires care. They're going to need that care next week, next month, next year. Nobody can change that fact. The only thing they can change is the price that they're prepared to pay for that and the circumstances under which that's accommodated. But the fundamental is that that cannot be taken away from us. That means that if equity markets crash, we still get our fees. If bond markets crash, we still get our fees. If property markets crash, we still get our fees. So the value of the property that we're providing the service from might have gone down, but the fees we're getting are still the fees. So the correlation, structurally, is very, very sound.
What is guaranteeing the fees?
Actually, I'll come to that too. It's a very good question. And there is some of it is guaranteed by the state, and some of it is private pay, and is guaranteed by an individual, which requires a bit of underwriting. It's also a real asset in that in order to provide this, you have actually got physical asset, and you've also got a person who, being slightly unemotional about this, a person is a real asset. So let's take a look at the market drivers in number terms. The first one is very obvious. We've covered the growth of the demographics of 85-year-olds. The next one is less obvious. This is, in fact, it's an area where our portfolio is overweight at the moment, providing care services to adults with learning difficulties. This is people with autism, Down syndrome, and these sorts of things, acquired brain injury. The important demographic shift in that one is that the life expectancy of people with these sort of issues has grown and is growing very dramatically. When I was born, had I been unfortunate enough to suffer from Down syndrome, my life expectancy would have been a full childhood and a very short adulthood. So my life expectancy would have been 22, 23 years. For people now with Down syndrome, their life expectancy is a full childhood and a full adulthood. Average life expectancy is now 62. And people with autism, Down syndrome, other mental health issues, they require care for that period. So the demographics of that are very, very strong drivers for a very solid base of requirement and need. And we like that because that means we've got a scalable market to play in.
But there should be less people with that syndrome now, no?
No, there's more because they're surviving longer.
Yes.
So,
but the new one, the newborn.
Newborn is the rate of people being born with autism, Down syndrome is higher than it was because obviously you've got higher survivorship of people with those sort of issues to be born in the first place. And you've also got some new issues. One of the big ones that's taking place in the UK right now, completely self-induced by the UK population, and it's also true in America, is called fetal alcohol syndrome. So women drinking alcohol during pregnancy, creating some very severe autistic-like mental health issues. So it's actually causing growth in the numbers, in the proportion of the population being born with issues. Sad, but true. So the number of people who require care is growing. We like that dynamic. It's unfortunate, but it's a fact. The other issue, you've got undersupply of people providing care. Because of the requirement for the capital base and the staff training and the regulation, there is an undersupply of care homes. And again, that creates a scenario for us to generate solid yield. I think the next slide deals with So what are the return characteristics that are generated by this? Now the first one is because you've got this known solid stream of fees being paid every week, and just to give you some price points, for elderly private pay residential care, the price point is £1,100 per week. That's our gross income. So we're getting £1,100 per week per person. For adults with learning difficulties, it's between £1,500 and £6,000 a week. So those are our price points. So we've got a known stream of yields coming there, against which we've also got known costs. The key one being staff costs, then we've got consumables and the cost of maintaining the property. So the yields on this, actually, the natural yields are around about 26-27%. So roughly, just under a third of those gross fees are available as profit. Our biggest investor is a charity, so they love this return stream because it's an inflation-linked yield play for them. Because what they need to do is every year generate yield from their capital to do their good deeds, and they want that yield to grow. They also like the fact that it's socially conscious investing. It's actually doing something of value to society. That's great, and usually people like that box as long as it's accompanied by strong returns. As it turned out, last year our portfolio did 27%, which makes everybody happy and makes ticking the social investing box even easier to do. The one issue, the one sort of risk that is not apparent in other investing is that of care quality. So we've got a known income stream, we've got a known cost base, high barriers to entry, but the one thing that is different to investing in paper is that of care quality. Something can go wrong. We look after currently around about 1,500 people across our estate, and we have 5,000 people doing that. These are challenging people being looked after by good professionals. Something can go wrong. You can get people getting hurt, getting inappropriate care, and we need to make sure that doesn't happen. That is a risk that is different, and we need to manage that and cater for that in different ways. Our view is we prefer to spend a bit more money on getting quality right, and the economics of that are we're able to charge a slightly bigger premium for the fees, and the occupancy level in our homes is higher. The way we've built the fund is to remove equity market short-termism. We have an open-ended fund with monthly liquidity, which means that the value that you can subscribe or redeem at is based upon the value of the portfolio on that day, and it's not subject to market sentiment. So if markets decide that they don't like property, equity, infrastructure, that doesn't have an impact on the value of the holdings, and that's very important to us to solidify the correlation issue. So I'm now going to just look at the two main areas and the dynamics between them, which comes to the issue about credit risk on fees. The reason we like adults with learning disabilities is in the UK there's a very, very important legal structure. The government are legally required to provide for all adults with learning disabilities, and adults, strangely, are aged between 19 and 65. Adulthood normally arriving at 18, in this case it's 19. The state have absolute responsibility for their care and are obliged to provide the best possible outcome. So it's not about suppressing the price, it's about best possible outcome, which is why they're prepared to pay £6,000 a week for the right care for that type of person. So this is fully state-backed, and it's funded at a level that makes it easy to provide good care and make a reasonable profit for the investors. We've invested in some of the biggest brands in the UK. We're currently the third largest player in the UK, and that's not just an ego issue. Scale in this market is becoming a very important economic component. People want to use the big players, they don't want to use the small players. And the other area we play in is private pay elderly. We do not play in the elderly care that is state funded in the UK. And that is because the state is looking to crush costs that it pays for the 500,000 people in its care, elderly care. The price point for state pay has moved from £600 a week 3 years ago to £400 a week now. You cannot provide care for £400 a week. So economically that's not viable for us. However, the fact that that price point has been crushed means that anybody who can pay does pay, which supports the private pay market. So all of our care homes are high-end, £1,100 a week. The average stay is 3 years, and the credit we have is on the individual. So this is actually a regional player in the UK. It only works in the southwest corner of England, really, because how do people pay for this care? It's because they have a house of value and a strong pension. Because they need to be able to fund £1,100 a week for 3 years plus. Just to touch on the issues, unlike in other investment houses, because we're dealing with physical assets, as well as building capability to do deals, buy businesses, make sure those businesses are well invested and run properly, we also need to make sure that the care quality side of it is covered as well. So we've actually put 2 wings on our company. One is our healthcare team. These are healthcare professionals who make sure that care quality standards are maintained at all times. And the other wing is the advisory board. There's a number of academics who advise government on policy, and we've employed them to advise us as well. So we can see what's coming down the road in terms of policy and make sure our portfolio is protected. I'll whiz through this because I notice the clock is almost out. One of the key issues in the sector is it's come from a place where there are lots of small players, which hasn't worked very well. The large players are now doing very well because they have a diversified care offering. The people making the decisions about who provides care like the fact that we have lots and lots of different types of care in our organisation, and that people's changing needs can be accommodated easily. So being geographically diverse and having a big portfolio is a very positive attribute. Very quickly, this is a deal we did last year, and we're doing more deals like this. We bought a company for £40 million in April 2014. It operated 25 homes. The homes themselves were fantastic, high occupancy levels, high quality, high average weekly fees, very good. The business was run as a family business that had kind of grown too quickly, so the head office function was deeply, deeply flawed. They were making £7 million profit a year at the home level and spending 2.6 of it at the head office level, whereas really they should have been spending about 600,000 a year. So we bought the business at 40 million, knowing that really it was valued at 60 million, fixed the head office, took us 6 months. We've just had the valuation through for this, it's 60 million. So we spent 40 to buy a 60 million pound asset, which is now generating yields of about 15%. This is another one we did. This is a new build. We have demand from a governmental organisation in the north of England who needed a facility for 12 high-need people. We spent 2.7 million of the fund's money to build that. Next month that's filled, 12 people in it. Average weekly fee is £5,500 a week to look after these people. 12 people being looked after by a staff complement of about 120, to give you an idea of the level of care that is necessary for these people. The profits that this business generates is 1.15 million. So we spent 2.7 million to generate profits of 1.15 annually. So that business is now valued at just over 10 million. So we quite like that one. And there's a few more of those coming through. Our portfolio at the moment has, in fact, this is a little out of date, we've got about 100 new beds that we've paid for in the portfolio but don't yet generate profit. So we paid for them out of cash. As yet, the profits have not fed into the valuation of the fund. So there's a lot of embedded value in our fund right now. And that's the summary. We've been doing this for just over 3 years. We've been established now as one of the smartest buyers in the area. Every time a business is for sale, we get first look at it. We turn away more than we buy, obviously. We're able to, in terms of purchasing, generate 2 times money over a 2-year period and buy yield at a very, very cheap rate. So the fund's done very well. We expect it to do very well this year because we'll be buying more and that will drive growth. Once the market settles down a little bit, that opportunistic factor will go away and we'll just be left with managing a very high yielding asset. And that'll be it. So hopefully that's given you a bit of a flavour. If anybody has any more questions and queries on it, I'll be around afterwards. Thank you very much.